Subscribe to my channel Report Stock.
All right, let's unpack this. Today, we're diving deep into the recent Q3 2025 earnings from, well, a significant player in Canadian finance, the Bank of Nova Scotia.
Right.
And this isn't just, running through numbers on a page. It's really a fascinating look at the pulse of the economy, a crucial barometer, really, for how a major bank navigates this pretty complex financial environment we're in. So, our mission for you listening in is to cut through all the jargon.
Yeah, there can be a lot of it.
Oh, yeah. We want to pull out the most important bits, give you a shortcut to understanding, how they performed, where the strengths are, maybe some surprising ones, the challenges they're facing, and what their leadership is actually doing about it.
And what's really illuminating here, I think, is that we get to look beyond just the headlines.
Exactly.
We can really dig into the granular details. These aren't just abstract figures. They tell a much richer story about, market dynamics, how the bank's responding strategically, and ultimately how these shifts in finance might be impacting, your own economic outlook. It's about connecting those dots.
Absolutely. So, okay, let's kick things off with the good news, because there was definitely some undeniably good news that jumped right out.
There was.
Bank of Nova Scotia, they announced adjusted earnings of, what was it, $2.5 billion?
$2.5 billion, yeah, which works out to $1.88 per share.
And that's up 15% year over year. I mean, that's a really impressive jump.
It is. And if we connect that to the bigger picture, that kind of growth, it signals pretty robust profitability, especially when you look at their return on equity, the ROE.
Right, the ROE.
That improved to 12.4%. Now, that's up 110 basis points compared to last year. And just for context, a basis point is 0.01%.
So a 1.1% improvement. That's significant. An expanding ROE, it's not just good news, is it? It's a critical sign that the bank isn't just profitable, but it's getting better, more efficient at using its capital. And, well, shareholder capital, too.
Precisely. Think of it like getting more bang for every buck invested.
Yeah.
And in this kind of, tighter economic climate, capital efficiency is just paramount. So this ROE improvement, a crucial advantage, tells us they're generating more profit for the resources they have. That's a key indicator of how effective management is.
Okay, and the positive story actually continues beyond those headline figures, too. We also saw their pre-tax, pre-provision earnings, PTPE, as they call it, jump by 17% year over year.
Right.
And crucially, their net interest margin, the NIM, that expanded by 22 basis points.
Okay, so for you listening, that PTPPE, it's a really strong indicator of the bank's core operating profitability before they account for potential bad loans or taxes.
Right, the underlying engine.
Exactly. So a 17% increase tells us their fundamental business operations are doing very well.
Yeah.
And that net interest margin, the NIM, that's arguably, the most fundamental profitability metric for a bank.
The bread and butter.
It really is. It reflects the health of their core lending and deposit taking. So that 22 basis point expansion, that's a meaningful shift. It tells us they're probably successfully repricing loans or maybe managing their deposit costs better to widen that crucial profit spread.
And it wasn't just interest income. Their non-interest income saw a healthy increase too. Hit $4 billion, which is up a solid 10% year over year. And that diversification of revenue, that's always a good sign, isn't it?
It truly is. Yeah, it shows the bank isn't solely reliant on traditional lending for its profits. That non-interest income, it could come from things like fees from wealth management, capital markets activities, maybe even credit card fees.
Right.
Having that diverse revenue base, it kind of acts as a hedge against volatility in any one area.
Okay, digging a bit deeper now into the balance sheet itself, we saw an improved loan-to-deposit ratio. That's down to 104%.
Yeah, from 116% back in Q4 2022.
That's a pretty big shift. And they're maintaining a strong CET1 ratio of 13.3%.
Right.
And that's after buying back 3.2 million shares.
Yeah, that improved loan-to-deposit ratio, it's a really positive sign.
Yeah.
It speaks to balance sheet optimization, better funding metrics. Essentially, it means the bank is funding more of its loans with customer deposits.
Which are generally more stable and cheaper.
Exactly.
Yeah.
More stable, cheaper than other funding sources. So it signals stronger liquidity, better risk management. And that 13.3% CET1 ratio, that's the common equity tier 1, it's a key measure of capital strength. It's their main buffer against potential losses. And to keep that ratio so robust, I mean, well above the 11.5% regulatory minimum after doing significant share buybacks, that really underscores their capital discipline.
So this isn't just like a passive outcome, it's a strategic choice.
Right.
In a volatile economy, having that high CET1, it gives them tremendous optionality, doesn't it? Whether it's for future acquisitions or just weathering unexpected downturns or maybe even accelerating shareholder returns down the line. It's like having a deep war chest when others might be, well, running on fumes. But, this leads me to ask, while being so robust with capital is obviously commendable, does it ever risk maybe leaving growth opportunities on the table? Or does it signal perhaps a more cautious outlook than they're letting on?
That's a really insightful question. And it's a constant balancing act for bank management, isn't it?
Yeah.
While sometimes a higher capital ratio can be seen as, lazy capital if it's not deployed efficiently in the current economic environment,
Yeah.
which is marked by uncertainty, potential headwinds.
Hmm.
Maintaining a strong buffer often signals prudence. It signals long-term resilience. It gives them the capacity to absorb shocks and, crucially, act opportunistically when others might be constrained.
Yeah.
So maybe it's less about missing opportunities and more about ensuring they have the strength to pursue the right opportunities without jeopardizing stability.
That makes perfect sense. Now, as we peel back the layers, it's often the subtle shifts, the things that maybe don't grab the headlines that reveal the true health of an institution. What were some of those less obvious indicators that caught your eye here?
Well, many numbers certainly look strong on the surface. We do see some areas that definitely warrant a closer look.
Okay.
The bank reported a provision for credit losses, or PCL, of approximately $1 billion.
Right.
And their PCL ratio was at 55 basis points.
A PCL and $1 billion. I mean, that's a substantial amount. What does that really tell us about the current lending landscape?
Yeah, that $1 billion PCL. Even though the PCL ratio actually decreased by 20 basis points quarter over quarter, which is an improvement.
Right, it's the nuance.
It is. But the sheer volume, $1 billion, tells us Scotiabank is still bracing for a significant amount of potential bad debt down the road.
Hmm.
It's like a family setting aside a really large emergency fund. It reflects their assessment of potential financial storms ahead.
Okay.
So for investors, and for you listening, it signals there are still ongoing credit risk concerns in the market. It means that while the rate of new bad loans might be slowing down a bit, the absolute amount they're setting aside for potential defaults is still pretty substantial. That points to persistent pressures on borrowers.
And adding to that pressure, maybe on the bottom line at least, their effective tax rate went up quite significantly.
It did.
To 25%, up from 18.6% last year. That's a noticeable jump.
Indeed. Yeah, a higher tax rate, it directly eats into net income, doesn't it?
Yeah.
It impacts the overall profitability. It's a factor that, well, it's not operational in nature, but it certainly affects the ultimate earnings per share figure.
Mm-hmm.
And it's also probably worth a quick mention, just for those who follow these kinds of signals, that Guru Focus detected 6 warning signs with BNS. Now, that's something some analysts track as maybe an indicator to look for potential underlying issues.
Yeah.
Prompts a deeper dive into the report.
Right. Something to keep an eye on. Okay, so now that we've kind of charted the overall financial landscape, the impressive highs, the strategic watch points, let's zoom in a bit. Let's drill down to the individual business units. Where did Scotiabank really shine, and which parts of the engine are maybe sputtering a bit?
Yeah, that's a great way to put it. The segmented performance really gives you that nuanced view. So on the shining side, Global Wealth Management. Earnings there were up a strong 13% year over year.
Okay.
This shows some really positive momentum across their asset management, private banking, and international wealth management divisions. This segment, it thrives on client assets under management, advisory fees.
Yeah.
So it suggests clients are either investing more or maybe their existing assets are appreciating nicely.
And it wasn't just wealth management, right? Global banking and markets had an absolutely stellar quarter,
Oh, yeah.
up an astonishing 29% year over year. That's incredibly strong performance in their capital markets and institutional banking side.
What's truly fascinating here is that Travis Machen, he's the CEO of Global Banking and Markets, he attributed that excellent quarter to, well, a volatile trading environment and robust equity markets.
No, market conditions helped.
Very much so. But he also noted that while building a, quote, durable franchise is the long-term focus, replicating that kind of performance consistently might be challenging. So this gives us a peek into the specific market conditions benefiting parts of the bank, but also, a realistic outlook on whether that's sustainable. It highlights how external forces like market volatility can really swing segment performance.
Mm-hmm.
Makes it kind of a high beta part of the business.
Okay, so given Machen's sort of realistic view that this level of performance might be hard to replicate consistently, what are the inherent risks for the bank if market conditions shift, if things become less volatile, how might they hedge against that?
Yeah, that's the million-dollar question, isn't it? For any capital markets division, if volatility subsides, if equity markets become more subdued, well, those trading revenues that fueled this quarter's growth could definitely diminish.
Right.
The bank likely tries to mitigate this through diversification within global banking, and markets focusing maybe more on advisory services, debt origination, other activities that are less sensitive to market swings. But ultimately, their ability to build that durable franchise Misha mentioned, that will be key to dampening the cyclicality, the ups and downs of this segment.
Okay. But not every segment saw this kind of explosive growth. Canadian banking, I mean, their home market, actually saw earnings down 2% year over year. That's a significant finding, impacting the, $959 million it generated. For a bank this size, why is their home turf struggling a bit?
This is indeed an area that the bank's leadership is actively addressing. L. Scott Thompson, the president and CEO, he specifically called out the Canadian business as requiring, his words, more work. And this is even while their international banking operations are apparently ahead of their Investor Day targets.
Interesting contrast.
It is. The struggle in Canadian banking, it could stem from a mix of factors, maybe slower mortgage growth because of higher interest rates, increased competition perhaps from fintechs or even other big banks, or maybe just a more cautious Canadian consumer who's facing inflation and higher debt payments.
Yeah, could be any or all of those.
Right. Understanding those underlying pressures is absolutely critical if you want to evaluate how effective their turnaround strategy might be.
So leadership isn't just watching this happen. They are prioritizing improvements here. What's their specific game plan? What are they actually doing to turn this around?
Well, they're clearly focusing on optimizing the balance sheet within the Canadian segment and enhancing transaction banking services to drive growth.
Yeah.
The aim, according to Thompson, is to achieve higher return on equities from these efforts by 2026 and 2027.
Okay, so there's a timeline.
There is. So while it's definitely a work in progress, they seem to have a clear path and a set time frame for improvement. That signals more of a strategic overhaul rather than just, minor tweaks.
Okay. Shifting focus then to international banking. Earnings there were up 7% year over year, reaching $675 million. Now, on the surface, that sounds pretty good.
Positive growth.
Right. However, the commentary also points out specific challenges with credit trends down in Mexico. That suggests some regional economic uncertainties.
And this is where those details really matter. Phil Thomas, he's the group head and chief risk officer. He explained that market dynamics, particularly in Mexico, are causing some weaknesses in their international commercial portfolio.
Okay.
This credit migration, it essentially means a deterioration in the credit quality of some loans down there, which leads to higher provisions for credit losses, but specifically in that region.
So it's localized.
He did note that, yeah. He said there are no significant trade-related impacts in Peru or Chile. So it seems to be a geographically focused challenge that they're managing closely. And that detail is important because it tells us the issue isn't necessarily a systemic problem across all their international operations, but rather concentrated. And sometimes those are easier to isolate and mitigate.
Right. So, okay, we've dissected the numbers, we've looked at the segments, the impressive strengths, the targeted challenges. The crucial question now, really, for anyone following this bank is, what does all this actually mean for Scotiabank's future strategy? How are they planning to tackle these challenges and, capitalize on their strengths?
That's exactly where the rubber meets the road, isn't it?
Yeah.
It's about more than just reporting the quarterly results. It's about signaling their forward-looking priorities, how they intend to navigate the next few years, and their capital strategy, as outlined by their CFO. That really sets the tone here.
Right. And Raj Viswanathan, the group head and CFO, he clarified their approach to deploying capital. He confirmed that 13.3% CET1 ratio is strong, and it was built through deliberate efforts over the past couple of years. Their priority for using that capital is clear. First, organic growth within the business itself, then considering credit migration, basically preparing for potential bad loans, and then share buybacks come into play.
Right, third on the list.
Yeah. They've already repurchased 3.2 million shares. They plan to continue, but always keeping a buffer well over that 11.5% regulatory minimum. That seems like a really clear roadmap, doesn't it?
It does. If we connect this back to the bigger picture, this capital strategy, it shows a confident but also highly disciplined approach.
Yeah, discipline seems right.
It suggests they feel they have enough flexibility to fund their own growth initiatives, absorb potential credit losses down the line, and return capital to shareholders, all while staying comfortably above those regulatory requirements. It's a delicate balancing act, really. Reflects a mature financial institution kind of understanding its priorities in the current economic landscape. It emphasizes stability and strategic allocation over just, maximizing immediate returns, which seems like a prudent stance given the broader uncertainties out there.
And for Canadian banking, that segment needing, as the CEO put it, more work.
Yeah.
A key focus is achieving sustainable, positive operating leverage. Eris Bogdanaris, who heads up Canadian banking, indicated they're aiming for this by next year.
Okay, so a near-term target.
Yeah, and this is expected as those investments they've been making in technology and productivity start to hopefully generate returns. That's a really clear target for you to watch. Gives us a specific timeline for improvement in that key segment.
And for you, the listener, positive operating leverage. It's essentially growing revenue faster than expenses are growing.
Right.
It's a powerful sign that those tech investments and efficiency drives are actually translating into higher profitability and hopefully sustainable growth. But this raises an important question, doesn't it?
Will it work?
Exactly. Will those technology and productivity investments truly pay off as expected? Will they reverse the Canadian segment's recent trend and help achieve those higher ROEs by 2026, 2027 that the CEO mentioned? It really underscores the importance of execution.
Yeah.
The strategy sounds clear, but the implementation and its impact on the bottom line, that's what will be critical to monitor. It's really a test of their ability to turn those strategic plans into tangible financial results.
Yeah, absolutely. And beyond the bank's internal strategies and segment performance, we really cannot ignore the broader external environment, right? That's the backdrop to all of this.
The macro picture.
Exactly. The commentary mentioned that the Canadian consumer is showing distinct signs of stress, particularly among younger clients. And that could very well impact future credit performance, not just for Scotiabank, but across the industry.
This is such a crucial point for broader economic health, isn't it? It highlights that even a strong financial institution like this isn't immune to those wider economic currents.
No, definitely not.
Monitoring consumer behavior, especially within key demographics like younger clients who often have, less financial resilience, it's essential for predicting future credit quality for the bank and, frankly, for gauging overall economic stability. It encourages that critical thinking about how these micro factors, like the bank's internal strength, interact with the macro factors like the external pressures coming from its customer base. These are the headwinds they've got to skillfully navigate.
So wrapping this up then, we've seen Bank of Nova Scotia's Q3 2025 earnings reveal, a multifaceted picture. There's strong overall growth, clearly bolstered by robust wealth management and impressive performance in banking and capital markets.
Yeah, some real bright spots.
Definitely. Yet it's also a story of targeted challenges, particularly in Canadian banking and those nuanced credit trends they're managing down in Mexico. And all of this seems to be underpinned by a pretty disciplined capital strategy that aims for long-term strength and shareholder value.
So given this intricate picture, the reported strength in overall earnings and capital, but then juxtaposed against these identified challenges like Canadian consumer stress and those specific regional credit issues, how might the bank's disciplined approach to deploying capital truly balance these short-term risks with its ambitious long-term goals for higher ROEs? What does this deep dive tell you listening in about the broader economic landscape right now, especially concerning consumer resilience and market volatility, and maybe what will you be watching for next in the financial sector?
Subscribe to my channel Report Stock.